Right. Note investing. We're going to unpack this whole thing today.
Yeah, sounds good.
You sent over a bunch of really cool research.
Yeah.
We're gonna break it all down
Right.
into, you know, the most important stuff for our listener, right?
Yep.
So it might sound a little dry, like at first, but I think there's actually some really fascinating stuff in here.
Right.
You gave us what looks like a cheat sheet
Right.
on
Great.
note investing strategies.
Yeah.
And then some I guess like top tips to think about before getting started.
Yeah. It's a lot to consider.
Yeah. So let's first, let's just figure out
Right.
what is this note investing thing? How does it actually work?
Sure.
And what should you be looking out for if you're thinking about trying it out?
Right. I think a lot of people are curious about it, but they're not really sure where to begin. It is kind of a different way to think about investing.
It is, yeah.
For sure.
So first things first.
Okay.
What actually is a note in this context?
So, imagine if you lend a friend some money and they write you a formal IOU. That's basically what a promissory note is.
Okay.
In note investing, that IOU is usually backed by something valuable, often real estate.
Okay. So it's like a more official version of like I owe you $20.
Yeah.
But instead of $20, we're talking bigger numbers.
Exactly.
And there's a house involved or a building or something like that.
Right. And then if the borrower doesn't repay that loan, then the note holder, the person who owns that IOU, can potentially claim the property.
Got it. Okay. So there's some serious potential upside there.
There is.
But also some risk involved.
Absolutely.
Which makes the first item on this note investing top list that you sent over even more important. Due diligence.
Yeah.
They really emphasize you cannot skip this step before you even think about investing in a note. You need to investigate everything.
All of it.
The borrower's credit history, the property's value, any outstanding debts or legal issues, the whole 9 yards.
It's like buying a house.
Right.
But in a way, it's even more important to be thorough because you're not just looking at the property itself, you're looking at the whole financial picture surrounding it.
Yeah, okay.
So for instance, you'll want to look at something called the loan-to-value ratio. Or LTV, and that compares the amount of the loan to the actual value of the property.
Okay.
A high LTV might be riskier because there's less cushion if the borrower defaults.
So it's like if the loan is for like $250,000, but the house is only worth $200,000.
Exactly.
That's a red flag.
Big red flag.
Because if you have to foreclose,
you're right.
You might not even get your money back.
You got it.
Okay. This list also mentions different asset classes, meaning there's different types of notes out there.
Yeah.
Performing notes, non-performing notes. Sounds like there's a whole spectrum.
There is. Think of it like stocks and bonds.
Oh. Okay.
Stocks are generally considered riskier with potentially higher returns.
Right.
While bonds are seen as more stable with lower returns.
Yeah.
So performing notes are kind of like the bonds of the note investing world.
Okay.
They're already generating a steady income stream because the borrower is making payments.
Gotcha.
Non-performing notes, where the borrower isn't paying.
Right.
Those are more like stocks. They're riskier.
Yeah.
But they also have that potential for much higher returns if you can turn them around.
Got it. Okay. So that brings us to risk management. Another big one on this list. And this is where I think things get really interesting because there's a lot of different ways to manage risk here.
There are.
They talk about analyzing that loan to value ratio like you just explained.
Right.
And also having reserves.
Yes.
Basically setting aside some cash.
Right.
Just in case things go south.
Just in case. Yep.
Right.
And you can also manage risk by choosing your strategy carefully.
Okay.
So for example, if you're really risk averse, you might stick with those performing notes.
Right.
If you're willing to take on more risk, you might look into non-performing notes or even discounted notes.
Discounted notes. What are those?
So that's where you buy a note for less than its face value.
Okay.
So let's say there's a note for a $300,000 house.
Right.
But the seller is willing to let it go for $200,000.
Okay.
Because maybe they need cash quickly or they're worried about the borrower defaulting.
Right.
You could buy that note at a discount.
Gotcha.
And either wait for the borrower to continue making payments or, try to work out a deal to get that loan back on track.
That's where loan modifications come in.
Exactly.
Right. They mentioned that on this list as well.
Yeah.
That's where you work with the borrower to change the terms of the loan.
Right.
Maybe extend the repayment period or lower the interest rate.
Right. It can be a win-win for both the investor and the borrower.
Okay.
The borrower gets some relief and the investor avoids the hassle and expense of foreclosure.
Right.
Which can be a very lengthy and complex legal process.
Yeah. Speaking of foreclosure, this list does touch on that, but they don't really go into detail. They just mention that it's a possibility.
Right.
If the borrower can't make payments and you can't reach an agreement on a loan modification.
It's definitely something to be aware of. And if you do foreclose, you could end up actually owning the property, which is known as an REO asset.
Okay. All right. So we've covered kind of like the basics of what a note is, the importance of due diligence.
Big time.
Some of the key things to consider when it comes to risk management.
It's essential.
Now let's move on to, I guess, the fun part.
Okay.
The strategies.
Right.
This note investing strategies list breaks down 10 different approaches.
Yeah.
Don't worry, we'll break down all the jargon so you can understand what each one entails.
It's like a buffet of options, each with its own flavor and level of spice.
I like that. Okay, so let's dig in. First up, we've got performing notes.
All right.
The ones we talked about earlier, where the borrower is making their payments on time.
Right. Investing in performing notes can be a good option if you're looking for a relatively stable and predictable income stream.
Okay.
Kind of like collecting rent from a rental property.
Oh, okay. So you're basically just buying, a stream of future payments.
Essentially, yeah.
But what about those non-performing notes?
All right. So those
sound a little bit more like a roller coaster.
They can be. Yeah. But that's also where the potential for really big rewards lies. Remember that treasure hunt aspect we mentioned earlier?
Yeah.
Non-performing notes, they can be like finding a diamond in the rough with the right strategy. You can potentially turn a distressed asset into a really profitable investment.
All right. So that's performing notes, non-performing notes. What else is on the menu here?
Well, we've got discounted notes, which we touched on briefly.
Right.
Remember, those are the ones that you buy at a discount because the seller's motivated to get rid of them.
Right. So it's all about kind of finding those hidden gems.
Exactly.
Those notes that are undervalued because of, some perceived risk or because the seller's in a tight spot.
Right.
But how do you know?
That's a good question.
If a discounted note is actually a good deal.
Right.
Or a potential money pit.
That's where due diligence comes back into play big time.
Okay.
You need to scrutinize every aspect of that note and the underlying property. Make sure you're not buying a lemon.
All right, got it. Due diligence. It's like the mantra of note investing.
It really is. It can make or break your success in this field.
So let's say you've done your due diligence.
Okay.
You found a discounted note that looks promising.
Right.
What's next?
Well, it depends on your strategy and the specific terms of that note.
Okay.
If it's a performing note, you're basically becoming the lender, right?
Right.
Receiving payments from the borrower according to the original loan agreement.
Okay.
Your profit comes from the interest earned on those payments.
Got it.
But if it's a non-performing note, things get a little more complicated.
More complicated in a good way or a bad way?
Well, it depends on how you look at it.
Okay.
With a non-performing note, you have a few options.
Okay.
You can try to work with the borrower to bring the loan current, maybe through a loan modification like we talked about. Or if that doesn't work out, you might have to consider foreclosure.
Foreclosure sounds intimidating, to be honest.
It can be. It's a legal process.
Yeah.
It can take time and money.
Right.
And there's no guarantee of a positive outcome. But it's one of the tools in a note investor's toolbox.
Okay.
And it's something you need to be prepared for if you're going to play in this space.
Okay. So we've covered performing notes, non-performing notes, discounted notes. What other strategies are out there?
Well, there's reperforming notes, which are basically non-performing notes that have recently become current again.
So it's kind of like a comeback story for a loan.
Exactly.
Yeah.
And these can be attractive to investors because you might be able to buy them at a discount, but they're now generating regular cash flow again.
So it's like getting a second chance at a potentially profitable investment.
That's a good way to put it.
All right. That makes sense.
What else?
Well, I've got commercial notes, which are backed by commercial properties like office buildings or shopping centers, industrial warehouses.
So bigger loans, bigger properties,
Yep.
potentially bigger rewards,
Right.
but also bigger risks.
Exactly. Commercial notes can be a lot more complex than residential notes
Okay.
because you need to understand the dynamics of the commercial real estate market, tenant occupancy rates,
Right.
lease terms, all sorts of other factors.
So definitely not like beginner territory.
Probably not.
Yeah.
But, for experienced investors who understand that commercial real estate market,
Okay.
commercial notes can offer, attractive yields
Right.
and diversification opportunities.
Okay. So we've got residential notes, commercial notes, performing notes, non-performing notes,
Right.
discounted notes, reperforming notes. I mean, that's a lot to keep track of.
It is. But we're not done yet.
What else? What else is there?
Well, there's investing in notes with a self-directed IRA.
Oh, which can be a tax-advantaged way to grow your retirement savings.
So you can actually use your IRA funds to buy notes.
You can, but there are specific rules and regulations you need to follow. It's important to work with a custodian who really understands self-directed IRAs and note investing.
Okay, good to know. What else?
We've got buying notes in bulk.
Okay.
Which is often done by institutional investors like hedge funds or private equity firms. They might buy a whole portfolio of notes from a bank or another financial institution at a discount.
Sounds like you need pretty deep pockets for that strategy.
You do, but it can be a way to get exposure to a large number of notes and potentially achieve really significant returns.
All right, so that's bulk note buying. What else is there?
Well, we've got direct seller financing,
Okay.
which is basically a way for sellers to provide financing to buyers who might not qualify for a traditional mortgage.
So instead of getting a loan from a bank,
Right.
the buyer gets a loan directly from the seller.
Exactly. It can be a win-win for both parties. The seller gets to sell their property and generate ongoing income from the note.
Okay.
And the buyer gets to purchase a home even if they don't have perfect credit or a large down payment.
That's really interesting. I can see how that would be appealing to both buyers and sellers in certain situations. What's the last strategy on the list here?
The last one is the secondary market.
Okay.
And that's where existing notes are bought and sold between investors.
So it's like a stock market?
You could say that.
For notes.
It's a more liquid option than holding notes to maturity.
Okay.
Because you can sell them to other investors if you need cash, or you think the market's moving in a direction that's unfavorable to your position.
Got it. Okay, so we've covered a lot of ground here.
Yeah.
10 different strategies.
Yeah.
That's a whole note investing smorgasbord.
It is, and we've only just scratched the surface. But before you get overwhelmed, let's take a step back and recap some key takeaways.
Yeah. Great idea. Let's distill this down to the essentials here.
Sure.
What are the most important things someone needs to know if they're thinking about, dipping their toes into the world of note investing?
Well, first and foremost, due diligence is paramount. I mean, no matter what strategy you choose, you absolutely cannot skip on researching the note, the borrower, the underlying property. I mean, you wouldn't buy a car without taking it for a test drive, right?
Right.
You shouldn't buy a note without doing your homework.
Right. And that homework involves, looking at things like the borrower's credit history, the property's value and condition, any liens or judgments against the property, any other red flags that might, indicate potential problems down the road.
You want to make sure you're getting a good deal and that you really understand the risks involved before you commit any capital.
Okay, so due diligence is number one. What else?
Legal considerations are crucial as well.
Okay.
Note investing is a legal minefield, and you need to understand the rules of the game before you start playing. Foreclosure laws, borrower rights, state-specific regulations, all of that can vary significantly from one jurisdiction to another.
So it's not just about understanding the financial aspects of note investing. It's also understanding the legal framework as well.
Absolutely. You need to know what your rights and obligations are as a note holder, and you need to make sure you're operating within the bounds of the law.
Got it. What else should people be aware of?
Market conditions.
Okay.
They play a huge role in note investing. Interest rates, economic downturns, local real estate trends, all of these factors can impact the value of notes and the likelihood of borrower default.
So you can't just analyze a note in a vacuum.
Nope.
You need to consider kind of the broader economic and market context.
It's like sailing a boat. You need to be aware of the wind and the currents if you want to reach your destination safely.
Great analogy. So we've got due diligence, legal considerations, and market conditions. Anything else?
Last but not least, risk management.
Right.
This is essential. No matter how tempting a note might seem, you always need to assess the potential downsides.
Okay.
What could go wrong? How much could you potentially lose?
Right. It's easy to get caught up in the excitement of a potential deal.
Yeah.
But you always need to kind of keep a level head.
Right.
Make sure you're not taking on more risk than you can comfortably handle.
Exactly. It's all about finding that right balance between risk and reward. And that balance will be different for every investor, depending on their individual financial goals, risk tolerance, and investment timeline.
Okay. So we've covered a lot of ground in this first segment here.
We have.
We've talked about what a note is, the importance of due diligence. Absolutely. Different types of notes and investing strategies, and the key considerations of, legal aspects, market conditions, and risk management. So what's next?
Well, now that we've laid the foundation, I think it's time to dive deeper into some specific scenarios. See how these concepts actually play out in real-world situations.
Sounds good to me.
All right.
Yeah.
It's like we've given you this toolbox full of specialized tools for note investing. Now it's time to actually see how those tools work in practice.
That's a great way to put it, yeah. I mean, we've talked about all these strategies, but I think it'd be really helpful for our listener to see how they might actually apply them in a real-world situation. Yeah. What if we walk through a hypothetical scenario here?
I like that. Yeah. Let's say you're browsing a marketplace for notes.
Okay.
And you come across a discounted note for a single-family rental property in a neighborhood that's been steadily appreciating in value.
Okay.
The note is being offered at a 20% discount to its face value.
Okay. That sounds promising.
It does.
But before we even, think about making an offer, what are the first steps we should take?
Due diligence. First and foremost, due diligence. Remember, there's a reason why this note is being discounted. We need to find out why.
Okay.
So we'd start by looking into the borrower's credit history and their payment history on this specific loan.
Okay.
Have they been making payments consistently, or have there been late payments or defaults in the past?
Right. And we'd also want to get a professional appraisal of the property.
Absolutely.
To make sure it's actually worth what the seller is claiming.
We don't want to end up with a note secured by a property that's overvalued.
Right.
Big mistake.
Exactly. And we'd want to order a title search too, right?
Yeah.
To make sure there are no liens or judgments against the property.
Right.
That could complicate things down the road.
Very important.
So let's say we've done all that.
Okay.
And everything checks out. The borrower has decent credit.
Right.
The property's valued appropriately.
Okay.
There are no major red flags. What are our options at this point?
Well, it depends on our investment goals and our risk tolerance.
Okay.
If we're looking for a relatively passive investment with steady income, we could simply purchase the note and become the lender.
Okay.
Collecting payments from the borrower according to the existing terms.
So we'd essentially be stepping into the shoes of the original lender.
Exactly. But if we're looking for a more hands-on approach with potentially higher returns, we could consider a few other strategies.
Like what?
Well, since this is a non-performing note, meaning the borrower is currently behind on payments, we could try to work with that borrower to bring the loan current.
That sounds like that loan modification strategy we were talking about earlier.
It is. We could reach out to the borrower, understand their situation, see if we can come to a mutually agreeable arrangement.
Right.
Maybe we extend the loan term, reduce the interest rate, or offer a temporary forbearance period.
So we're trying to find a solution that kind of helps the borrower get back on track.
Exactly.
While also protecting our investment.
It's that win-win scenario.
Right.
Yeah.
Exactly. But what if the borrower is unresponsive?
That's a good question.
Or unwilling to cooperate? What if they've abandoned the property and they have no intention of making these payments?
Right. Well, then things get a little more complicated.
Okay.
In that case, we might have to consider foreclosure.
Can you walk us through what that process might look like?
Sure. Foreclosure is a legal process that allows a lender to take possession of a property when the borrower defaults on the loan.
Right.
The specific procedures vary from state to state, but it generally involves filing a lawsuit, notifying the borrower, and ultimately holding a public auction to sell the property.
So it's not a quick or easy process.
It can take months, even years, to go through the whole process.
Wow. Okay.
And it can be quite expensive.
Right.
In terms of legal fees, court costs.
And there's no guarantee that, like, we'd even be able to recoup our full investment.
Right.
Even if we do foreclose on the property.
You could end up owning a property that needs significant repairs or that's worth less than the amount owed on the loan.
So foreclosure is definitely like a last resort.
It is.
And it's a decision that should be made carefully after considering.
Yeah, it's not something to be taken lightly.
Right, exactly. Okay, so we've explored a few different strategies here for dealing with this hypothetical non-performing note. We could, buy it, become the lender, hoping the borrower eventually catches up on payments. We could try to modify the loan terms to help the borrower get back on track, or as a last resort, pursue foreclosure. But how do we even measure out which strategy is the right one?
That's the million-dollar question, isn't it?
It is.
And unfortunately, there's no easy answer. The best approach really depends on a variety of factors, including the specifics of the note, the borrower's situation, our risk tolerance, and our investment goals.
So we need to kind of weigh the potential risks and rewards with each strategy and then make an informed decision based on our individual circumstances.
And that's where experience and expertise come in.
Okay.
If you're new to note investing, it's crucial to seek guidance from somebody who's been there and done that.
Right. Don't just jump in head first without doing your research and understanding the potential pitfalls.
Note investing can be a very rewarding way to build wealth, but it's not for the faint of heart.
Okay, so we've walked through a hypothetical scenario here involving a non-performing note. But what about some of those other strategies we talked about earlier?
Okay.
Like performing notes or discounted notes. How might those play out in a real-world situation?
Well, let's imagine a different scenario. You're looking for a more passive investment with a steady stream of income.
Right.
You come across a performing note for a multifamily property in a stable neighborhood.
Right.
The note has a few years left until maturity, and the borrower has a solid track record of making payments on time.
Okay, so this sounds like a lower risk option.
It is.
Than the non-performing note we just discussed.
It is. But it's important to remember that even with performing notes, there's always some level of risk.
Right, okay.
The borrower could still default.
Right.
The property could decline in value, or interest rates could rise.
Right.
Making your note less attractive to potential buyers if you decide to sell it before maturity.
So due diligence is still crucial even with performing notes.
Absolutely. You always want to verify the borrower's income, their employment history, analyze the property's financials, and make sure that rental income is sufficient to cover the mortgage payments.
And we also want to assess the overall condition of the property, right?
Yeah.
Make sure it's well maintained and doesn't require any major repairs.
Exactly. Now, let's say we've done all of our due diligence.
Okay.
Everything looks good. We decide to purchase the performing note.
Yeah, right.
What happens next?
Well, I guess we just sit back and collect the payments, right?
That's the idea.
Kind of like being a landlord, but without the hassle of actually managing the property.
Exactly. But even with performing notes, it's important to stay informed,
about the borrower's situation and the performance of the underlying property. We want to monitor payments, make sure they're being made on time. And we also want to stay up to date on any developments in the local real estate market that could impact the value of our investment.
So it's not entirely passive, even though it's a performing note.
It's not. There's still some level of involvement required to protect your investment.
Okay, that makes sense. Now, what about discounted notes? We talked about them briefly in the context of non-performing notes. But can you give us an example of how, a discounted note strategy might work with a performing note?
Let's imagine you come across a performing note for a retail property in a busy downtown area. The note has several years left until maturity. But the seller is willing to offer, let's say, a 10% discount. Because they need to raise capital for another investment opportunity. Okay, so the note is performing.
Right.
Meaning the borrower's making payments on time.
Correct.
But the seller's offering a discount.
Right.
Because they have this, like, need for liquidity.
This is actually a very common scenario in the note investing world.
Okay.
Sellers might offer discounts for a variety of reasons.
Okay.
Like needing to raise capital quickly, wanting to avoid the hassle of managing the note,
right,
or simply wanting to diversify their investment.
So as a buyer, we have this opportunity to purchase a performing note at a discount.
Yep.
Which could potentially boost our returns.
That's the idea.
Okay, but again, due diligence is paramount here.
Always. We would want to investigate the borrower's financial situation, the performance of the retail property, the terms of the lease agreement, make sure the rental income is stable and sufficient to cover those mortgage payments.
And we'd want to analyze, like, the overall market conditions for retail properties in that particular area.
Absolutely.
To assess the long-term viability of the investment.
You wouldn't want to buy a note for a retail property that's likely to struggle in the coming years due to declining foot traffic or competition from online retailers.
Right. All those market factors.
Exactly.
So even though it's a performing note offered at a discount, there are still risks to consider.
Absolutely.
And due diligence to be done.
There's no such thing as a risk-free investment, especially in the world of note investing.
Okay, so we've explored a few different scenarios here involving performing notes, non-performing notes, discounted notes. We've talked about the importance of due diligence, the different strategies we can employ, the risks and rewards we need to consider. But I think our listener might be wondering about, like, the practical aspects of this. Like, where do you even find these notes?
Yeah, that's a great question. There are a few different ways. You can find notes through online marketplaces, note brokers, real estate auctions, and even directly from banks or other financial institutions.
So there's like a whole ecosystem out there.
There is.
For note investors to tap into.
And each sourcing method has its pros and cons.
Okay.
You know, online marketplaces offer convenience and a wide selection.
Right.
But you need to be careful about vetting sellers and doing your due diligence.
Right.
Note brokers can provide guidance and expertise,
okay,
but they typically charge fees.
Right.
Real estate auctions can offer bargains,
okay,
but they can also be very competitive and fast-paced. And then buying notes directly from banks can give you access to, you know, high-quality assets,
right,
but the process can be a lot more complex and time-consuming.
So it sounds like there's no one-size-fits-all approach to sourcing notes.
There isn't. The best method will really depend on your individual preferences and your investment goals.
And it's often a good idea to diversify our sourcing methods, right? To increase our chances of finding good deals.
Absolutely.
Okay, that makes sense. So let's say we found a note that we're interested in.
All right.
We've done our due diligence, and we're ready to, like, make an offer. What happens next?
Well, the negotiation and closing process for a note purchase is actually pretty similar to that of a traditional real estate transaction. So we would submit an offer, negotiate terms with the seller, and if we reach an agreement, we sign a purchase agreement.
And then we'd need to, like, close the deal with the help of, you know, a real estate attorney or closing agent.
Exactly. They'd handle all the legal paperwork, transfer the note to our name, and ensure that all the necessary documentation is recorded properly.
So it's important to have, like, a good team in place.
It is.
When we're buying and selling these notes.
A knowledgeable real estate attorney, a reputable closing agent, and a trusted financial advisor can be invaluable assets in this process.
Okay, so we've covered a lot of ground in this deep dive into note investing.
We have.
We've discussed the basics, the strategies, the risks, the rewards, the practical aspects of buying and selling notes. But I'm wondering, before we wrap things up, if there are any, like, common misconceptions or pitfalls.
That's a great point.
That note investors should be aware of.
Note investing, you know, it can seem like a get-rich-quick scheme, especially when you hear these stories about people making huge profits from distressed property.
Right, exactly.
But the reality is that note investing is a complex and nuanced field that requires knowledge, experience, and a healthy dose of caution.
So what are some of the, like, the biggest mistakes that new note investors tend to make?
One of the most common mistakes is underestimating the importance of due diligence.
Cool.
You know, new investors might get caught up in the excitement of a potential deal and rush into it without thoroughly investigating the note, the borrower, the property.
Yeah. I mean, we've said it before and we'll say it again. Due diligence.
It's crucial.
Absolutely crucial.
Another common mistake is failing to account for all the costs involved.
Okay.
You know, new investors might focus solely on the purchase price of the note without considering, you know, the potential expenses of legal fees, closing costs, property taxes, insurance repairs, and so on.
So it's important to factor in all those
It
potential costs when you're evaluating a deal.
Absolutely. And another mistake is overpaying for a note.
Okay.
Just because a note is being offered at a discount doesn't necessarily mean it's a good deal.
Right.
You need to analyze the note's intrinsic value based on the borrower's creditworthiness, the property's condition and market value, and the prevailing interest rates.
So we need to do our homework and make sure we're not overpaying for a note just because it seems like a bargain.
Exactly. And finally, I think a common pitfall for new note investors is getting emotionally attached to a deal.
Okay.
They might fall in love with the property or get fixated on a particular strategy without considering all the angles.
So it's important to kind of stay objective.
It is.
And make decisions based on logic and data, not emotions.
Note investing is a business.
Right.
And you need to treat it as such.
Okay, so we've talked about some common mistakes to avoid, but what about some of the more advanced strategies that experienced note investors might employ?
Yeah.
I mean, we touched on a few earlier, like buying notes in bulk or using self-directed IRAs.
Right.
But are there any other sophisticated techniques?
Well, one advanced strategy is note flipping.
Okay.
Which involves buying a note at a discount and then quickly reselling it for a profit. This can be a very profitable strategy if you have a good understanding of the note market and you can identify undervalued notes.
So it's kind of like flipping houses, but instead of flipping properties, you're flipping notes.
Exactly. And another advanced strategy is using leverage, which involves borrowing money to purchase notes. This can amplify your returns, but it also increases your risk.
That it's a high-risk, high-reward strategy.
It can be. And another advanced strategy is participating in notes, which involves investing in a portion of a note rather than the entire note. This can be a way to diversify your portfolio and gain exposure to a wider range of assets.
So it's kind of like buying a share of a note.
I could say that.
Rather than the whole note.
Exactly. And those are just a few examples. I mean, there are many other advanced note investing strategies out there. But I think the key takeaway here is that note investing is really a multifaceted field with a lot of different approaches. The best strategy for you will depend on your individual goals, risk tolerance, and experience level.
So it's important to do your research.
Absolutely.
Understand the risks involved and start slowly.
Start slowly. Don't try to do too much too soon. Start with a small investment. Learn the ropes, and gradually increase your exposure as you gain experience and confidence.
Okay, so I think we've covered a lot of ground in this deep dive into note investing.
I think so.
We've talked about the basics, the strategies, the risks, the rewards, the practical aspects, and even some advanced techniques. But I think the most important takeaway is that note investing, like ANY investment, requires careful planning, thorough due diligence, and a solid understanding of the market.
It's not a get-rich-quick scheme. It's a business that requires knowledge, skill, and patience.
So if you're thinking about getting into note investing, do your research, seek guidance from experienced professionals, and be prepared to put in the time and effort to succeed. It sounds like note investing is a bit like surfing.
Yeah, I like that analogy.
You need to learn how to read the waves, choose the right board. Be prepared to wipe out a few times before you catch that perfect ride.
Exactly. There will be ups and downs, but with practice and perseverance, you can ride those waves to financial success.
Okay, so we've covered a ton of ground here. We've talked about the different types of notes, the strategies you can use, the risks you need to be aware of, the potential rewards. What stands out to you as the most important takeaway for our listener? I
think the most important thing is to approach note investing with a with a balanced perspective.
Right.
It's not a magic bullet for, getting rich quick.
Right.
It's a business that requires careful planning, thorough research, and a willingness to learn and adapt.
So don't go into it with unrealistic expectations.
Right. Don't expect to get rich overnight.
Yeah.
Be prepared to put in the work, make mistakes, and learn from them.
And don't be afraid to seek guidance from experienced professionals.
Absolutely. Find a mentor, join a note investing group, attend conferences,
Right.
read books and articles. The more you learn, the better equipped you'll be to make those informed decisions and avoid costly mistakes.
So it's all about education, due diligence, and a realistic mindset.
Exactly. If you go into it with those three things, you'll be well on your way to success in the note investing world.
That's a great note to end on. But before we sign off,
right,
I want to leave our listener with a thought-provoking question here.
Yeah, I'm all ears.
Imagine you had a chunk of cash to invest, right?
Okay.
Knowing what you know now about note investing.
Yeah.
What kind of note would pique your interest? What kind of property or borrower situation would make you want to learn more?
That's a great question to ponder.
Yeah.
It really forces you to think about, your own risk tolerance,
right,
your investment goals, and your overall comfort level with different types of properties and borrower profiles.
Exactly. There's no right or wrong answer here.
No.
It's all about finding the right fit
for
your individual circumstances and investment style.
And that's the beauty of note investing. There's so much variety and flexibility. You can really tailor your strategy to fit your specific needs and preferences.
Well said. And with that, I think we've reached the end of our deep dive into note investing.
It has been a fascinating journey.
It has, yeah.
For sure.
I agree. And I hope our listener has gained a valuable understanding of this complex and potentially rewarding field.
Absolutely.
So until next time, keep learning, keep exploring.
Diving deep.
And keep diving deep into the world of knowledge.
Into the world of knowledge. And remember, always do your due diligence.
Couldn't have said it better myself. See you on the next deep dive.